I'll give you my contact information at the end. Really helping my clients, whether it's individuals and business owners, understand inflation risk, business risk, and real estate risk, and how it affects your purchasing power. If anyone wants these slides at the end, you can either email that email address that Janean gave, or you can also email me directly. So when we hop into things, just want to start off with understanding inflation risk and then also real estate on Oahu, because that's one of the two major things that my clients will look at. And to break down inflation, it's a general increase in prices and the fall in purchasing power. So long-term inflation is about 3%. More recently, it's more towards 2%. And so what that means is in a low interest rate environment, our ability to contain with inflation risk or with inflation is very difficult. So I'm earning 0.02%, so that spread between 0.02. So the first type of risk that I like to educate my clients on is principal risk. That's essentially, if your investment is time, is there a guaranteed return of principal? Okay. So the benefit of using your checking and savings account is that there's zero principal risk. Anything that's at the bank up to $250,000 is FDIC insured. Anything in excess of $250,000 is not FDIC insured, just to kind of give you a heads up on that. Okay. So checking and savings account should be utilized as an emergency nest egg. And the best rule of thumb is to keep at least 3 to 12 months worth of living expenses liquid in cash. For any business owners that are commission driven or that month to month cash flows are consistent, I would err on the higher end of more towards 12 months or a year. But for anyone that has more consistent cash flows, that you may want to go in the 3 to 6 month range, but it kind of depends on what you're with. Okay. And so anything in excess of that emergency nest egg, you have to realize is susceptible to inflation risk, business, and real estate risk. Okay. And so the next type of risk is inflation risk, and again, our in power over time. And I like it to break it down in 3 different examples using a time frame of 17 years. So the first example is a gallon of gasoline. So if you wanted to get a regular gallon of unleaded gasoline back in 2000, it was $1.25. Okay? And I thought it was expensive back then. And so if you were to put that $1.25 in your pocket back in 2000, sleep for 17 years, I were to wake up in my office in Kaka'ako, go to Texaco, and want to purchase a gallon of regular unleaded gas, I'd be in for a rude awakening, because now it would run me about $3. For that exact same good, for the exact same quantity, it'd run $3. Okay. When you talk about education, it's even more so, the increase year over year. So 1 year tuition, room and board when I went to Pepperdine was $31,000 a year. And in that same scenario, if I were to sit on that $31,000 for 17 years, not earning any interest, and expect if I had a son or a nephew or niece that wanted to go to Pepperdine, I'd be in for a rude awakening, because now for a single year of tuition, room and board at Pepperdine is $68,000 per year. Okay. As it pertains to real estate, back in 2000, 10-20% to purchase a home for $295,000, and you said, "Hey James, you know what? My year is going to be 27." You'd be again in for a rude awakening, because it would be that the value of that home now would be about $735,000. I think a lot of people don't really understand that their money needs to grow at a certain rate year over year just to maintain its purchasing power. And so as as those that are tuned in, want to discuss what's business risk. And so it's basically understanding inflation and how it affects the cost of goods and services for your specific business. So business owners often look at the cost of technology, any processing systems, payroll, fulfillment systems, cost of staff, whether it's hiring additional staff, pay raises over time, and also health or maybe some types of benefits. And then costs and goods and services, production costs, transportation costs, etc. So it's going to be specific to your industry, and usually I'll work with small business owners to determine what type of goods and services over a certain time frame, what then needs to grow at just to maintain its purchasing power. Okay. And then stock market risk. So a lot of business owners will set up, either investment accounts to help them keep up with inflation, in some cases exceed inflation. But stock market risk is essentially investments in portfolio values will fluctuate based on interest rates, economic factors near and abroad, and then law and policy changes. Okay. It's often recommended a buy and hold strategy to reduce your market timing and or risk. And anytime there's emotional decisions involved, that's oftentimes when people get burned. So back in 2000, the tech bubble, 2008, 2009, the mortgage crisis, if people made emotional decisions during those times, then it probably accumulated some type of loss. Okay. But with utilizing the market for long-term goals, you do have an opportunity to either keep those exceed inflation. Okay. And the last type of risk that a client discuss is real estate risk. So that means I've done research with some of my realtors and mortgage lenders, and we identified by going to the Honolulu Board of Realty that the average annualized return for a single family home from 1985 until today is about 4.9%. So we're looking at the past 32 years, the good years, the bad years, and just averaging out the return. And year over year, its return is going to be 4.9%. And so for those that say, hey, James, I can time the market. I know what real estate market's going to do in Oahu. And so in the most positive or bullish scenario within a 10-year window, it was from 2000 to 2011, in which if somebody were to invest in a single family home on Oahu, their cumulative return would have been 71.2%, which averages out to 7.12% year over year. In the most negative or bearish scenario happens to be the last 10 years, in which, again, average single family home on Oahu, you would have gotten a cumulative return of 16.4% or average 1.64% year over year. So why does this matter? A lot of people, again, don't understand inflation risk and real estate risk. So if you're either buying a primary or investment property and your money isn't earning at least 4.9%, you are potentially losing purchasing power over time. So when I sit down with people that want to save with their checking and savings, they're going to have to work a little bit harder for their money, because their money isn't going to keep up with 4.9% based on the low interest rate environment at the bank. Okay. So just to make sure you folks don't think that I'm just making up the numbers, and I can send you this link afterwards, but this is from the Honolulu Board of Realty statistics from 1985 to 2016. And the number that we're looking at for a single family home on Oahu, year over year is 4.91. Cumulative return over that time is 363.4%. Okay. So it may be specific to your business and it may be specific to the individual, but you want to determine and understand a purchasing power. So what essentially that means is, if you look at the interest rates right now at the bank, I bank at Bank of Hawaii, I'm getting 0.02% interest. Okay. The gap between the interest that I'm receiving at the bank and inflation, which is 3%, this gap here, that's your inability for your dollar to maintain its purchasing power over time. Real estate risk comes into play when you can identify the spread between getting at the bank versus what your money needs to earn. And in two personal scenarios, cost of care or long-term care in Hawaii is 5%. So again, the spread is cost of care risk or long-term care risk. And then cost of education is even loftier at 6% year over year. So for those clients of mine that are using a savings account to save for little James Jr.'s college account or college fund, 16 years out, the number that they are earning at 0.02% is far less than what it needs to just to maintain its purchasing power. Okay. So it's important to balance your risk and understand what type of risk you're going to be susceptible to. But I always want to make sure that business owners and individuals create that nest egg, that emergency bucket of money. And that's, again, going to be that 3 to 12 months worth of expenses. Once they have that established, then they need to identify midterm goals that they have in which they're just hoping their money can maintain with inflation and maintain its purchasing power. Thereafter, for any goals 5 or more years out, or Oahu real estate, maybe the stock market, to try to exceed inflation. And only when you're getting in excess of 3% return is your money actually working for you. Okay. So for those of you that play golf or understand golf, the analogy that I like to use is inflation rate should be your par. So if we look at inflation at 3%, anything less than 3%, we're losing purchasing power, and anything in excess of 3%, you're increasing your purchasing power. Your par shouldn't be 0 or 0.02, the interest that you're getting at the bank. Your par over time needs to be 3%, and that's something that I wish I understood when I was in my 20s, and be able to kind of understand either how my money was working for me or how it wasn't working for me. Yeah. So the best way to develop a month-over-month strategy, and this is what I personally implement for my own finances, is I determine on a monthly basis, after income comes in and my monthly expenses, I try to identify what that surplus is. So I think that's the first step to really addressing inflation risk and how to maintain purchasing power over time. So just determine what comes in, what goes out, and if there's a surplus. Okay. Then with our 3-bucket strategy, utilizing the checking and savings for that emergency, protection strategy for goals 1 to 5 years out to try to maintain with inflation rate risk, real estate, and maybe business risk. And then long term, utilizing the stock market to try to exceed inflation and then earn more purchasing power over time. So the continuum below, interest rate, this gap is inflation risk, and then this gap between 0.02% and 4.9 would be real estate risk. So what you want to try to determine is that from that surplus, if you need to buffer your emergency nest egg, there should be a fixed dollar amount that goes into this month over month until that this is filled. Thereafter, for any midterm goals, you want to allocate funds, and then any long-term goals you want to allocate to more growth-oriented investments. But it should be a blend or a diversification of your midterm needs and then your long-term needs. Now, for those, oftentimes when I sit down with business owners and individuals, they'll be sitting on a lump of cash that they don't really associate any specific financial goal or objective with. Okay, so I think the biggest opportunity is first identifying if you have that 3 to 12 months in emergency cash available, and anything in excess we should be considering that second and third bucket dependent upon what those goals are. Okay. Strategy that is going to eliminate all risk. So it's important to be conscious of what type of risk you're susceptible to based on the time saving or the time frame that you have associated to that financial goal or objective. Okay. So this is going to apply to business owners, and I usually sit down with them and I identify that midterm goal, midterm bucket, that inflation protection strategy. The objective is just to maintain purchasing power over time and reduce inflation risk. Interest rates remain low at the bank. Okay. And so possible financial goals may be buying new equipment, an advertising or marketing fund, or expanding business, whether it's increase in production, hiring new staff, etc. Okay. Again, the goal here is to maintain purchasing power and be able to services over time. Investment strategies. So when I talk about investment strategy, we're talking about more long-term goals, 5 or more years out from now, in which we're going to try to utilize the stock market to exceed inflation or improve or grow our purchasing power. Okay. So possible financial goals that may be associated with this is acquisition of other companies, other smaller competitors, in which we're looking to buy out other businesses to expand the business and take over market share, increase volume and production, and then also open new location, whether it's neighbor island expansion or locations around Oahu. Again, the goal in this, utilizing this bucket or strategy, is to exceed inflation and have your money working for you, knowing that par is 3%. Real quickly, because I wanted to have this focus on businesses, but on the individual level, same thing. If you want to utilize that inflation protection strategy or midterm purchasing power, scenarios in which I see clients utilize this is either for buying a home, if their time frame is 1 to 5 years. Maybe they'll utilize it as a travel fund or a holiday fund just to get a little bit more earning or interest on their dollar. Saving for children that are already in middle school or high school, so they don't want to be susceptible to market risk due to this shorter time frame in which their child may be heading into college. And for me personally, I use it as a super savings account so that anytime I have any excess business expenses, travel, meantime, it's earning a little bit more interest than what I would be getting at the bank. And then if there's a pullback in certain stocks or mutual funds or investments in the market, I can then move it into my third bucket to try to exceed inflation. The goal here again is to maintain purchasing power over time and buy the same goods and services over time. Okay. In that third or long-term bucket, possible financial goals for individuals would be buying real estate investment property, saving for long-term care if they're choosing to self-insure. And again, that bogey that you want to hit or the par for long-term care is 5%. And then saving for college for young children, because there's a wider time frame or gap, then you can have some market risk to try to exceed inflation or keep up with educational par, which is 6%. Okay. Again, this goal is to exceed inflation and have your money working for you. Okay. Please consult with Janean or a tax professional to determine the tax implications if you draw down from certain assets. Are there tax deduction opportunities when saving, and whether it's 1031, 1035 with life insurance, what type of opportunities are going to allow you to be the most efficient when accessing assets to either expand your business, buy real estate, whatever. Consult with the financial advisor to determine which bucket is best to distribute funds from and what type of risks are we either reducing or increasing. Determine which bucket to invest in based on your time frame, and the shorter the time frame, the more that principal is important, The longer the time frame, you may want to try to exceed inflation, in which there will be some principal risk. Okay. Knowledge is power. It's really important for everyone to understand what inflation, business, real estate risk is and how it affects your buying power. I'd say the biggest benefit and the biggest impact for clients is to determine a monthly budget strategy, and this avoids market timing. So if they're just allotting a certain amount per month, then they designate it or allocate it to their specific money buckets. That will help them address inflation. So like my college volleyball coach said, it's a process in which Rome wasn't built in a day. Okay. And then you want to determine the source of assets are appropriate for your specific time frame, its financial objective, and also the tax implications for each. Okay. If you folks have any questions or concerns, want to sit down for a complimentary consultation, or want to receive these PowerPoint slides, I'd be more than happy to send those to you. That's my email address, my phone, and then if you wanted to fax any information for me to review, to just help determine which bucket it would fit into based on your current savings, budgeting, and investing strategy is, I'll be more than happy to give you a second opinion. And I think that is it.
Thanks, James. You know, I think as business owners, a lot of us are a little, we're always focused on the short-term goal. Really the next step to start setting up these middle or long-term buckets. I think really, our listeners, our viewers need to sit down with you so you can determine if they're addressing each of their risks.
Yeah, and I think it's important, whether it's me or any financial advisor, they should be able to, really frame and help, business owners and individual savers and investors understand inflation risk. And it's something that, with our generation or our parents' generation, they just happen to be savers. They just put aside money. They don't really understand that over time, if it's not growing at 3%, they're simply going to have to work longer, work harder, knowing that their purchasing power over time is going to slowly dwindle due to inflation risk because interest rates remain so low.
You're right when you said that. I wish I knew these concepts back when in my 20s. They don't teach this.
Yeah, and I think just starting by little bits and pieces, and really, and if there is a surplus, that's going to be the easiest way for people to expand their business, to plan their financials, understanding inflation risk for those real estate investors and understanding real estate risk, and then for those business.
Well, I want to thank you, James, for sharing your knowledge with us. We are at the end of our time today. As always, you can email James directly. You can also email us at info@smarttaxhawaii.com. We look forward to next week, same time, same place. Thank you again for joining us, and have a great week, everyone.
Okay. Thanks, Janine. Thanks for having me.